In this week's video, we'll review some extremely interesting charts and ask the question, what can we learn about 2017 from these stock market fractals? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll start the video with some generic concepts about market fractals and then tie those concepts in a specific manner into the present day or July of 2017. With market fractals, we can take charts of the S&P 500. If we remove the scale, it's very, very difficult, if not impossible, to tell the difference between a 1-minute chart, a 10-minute chart, a 15-minute chart, a 30-minute chart, a 60-minute chart, a daily, weekly, monthly, semi-annual, or annual chart. A quick example, these are screen captures that were taken intraday on July 27th. This is a daily chart spanning 7 months. This is a 30-minute chart spanning only 15 days, and you can see price action looks similar on both time scales. And as we progress through these slides, we'll move closer and closer to July of 2017. These are two snapshots of the stock market. We'll quickly walk through some similarities. Both of them start with a rally, a give back, a sharp rally, a sharp give back, another rally that comes up near the previous high, another rally that comes up near the previous high in both cases. And next, in both cases, price moves back down toward the bottom of the range. And in both cases, we see sharp rallies off of this low. If we look at these charts closely, this is a bullish breakout above this high and this high. This is a bullish breakout. It exceeds this high and this high. In both cases, the bullish breakout morphs into what appears to be a failed breakout. Price comes back into the range, price comes back into the range, and then in both cases, the market rights itself and goes on and prints a higher high above this high and a higher high above this high. Thus, like the daily and 30-minute chart of the S&P 500 that we reviewed at the beginning of the video, these charts have some similar characteristics in terms of price movements. What charts are we looking at? Let's start with the chart on the left. The chart on the left is the value line geometric index from 1980 to 1995. Since the left and right sides share some similar characteristics, it might be helpful to know what happened next in this case. So let's move this. This is the exact same chart, and this is just a larger version of the smaller chart in the lower left-hand corner. We can guess what happens next. We know the longer a market goes sideways, the bigger the move that we can expect to get when we either get a bullish breakout or a bearish breakdown. In this case, for illustrative purposes, let's look at this point here. This is the breakout here at 311. When the index was trading at 311, we're exceeding this high here, and this high here. From point A to point B, after the successful breakout in June of 1995, the value line geometric index rallied for 1,026 days into 1998. The gain from point A to point B was 68%. If we're going to compare the fractals head to head, the easiest way to do it is to look at the highs here and see how long it took from this high resistance, there was some resistance in here, and then the breakout. In this case, from the first high for the consolidation where it was rejected, the box was 2,862 days, or we went sideways for 7.84 years. The longer we go sideways, the bigger the move we can expect to get. So let's go back and compare the fractal on the left and the fractal on the right. Fractals speak to proportions. Therefore, we would expect this box, or really this line here of resistance, to have similar proportions on the right side, which is exactly the case. This box, from a proportion perspective, is for the most part exactly the same as the one on the left. On the left, we've already shown that this was 7.84 years of consolidation from the first high to the point we're looking at here. We already know that this is 1980 to 1995 on the left. What are we looking at on the right? We're looking at the exact same value line geometric index. This is a weekly chart. This is a weekly chart. Instead of spanning from 1980 to 1995, this version spans from 1980 all the way out to the present day. And to simplify things, we're really looking at sideways consolidation. A point, a point, a point, a point. Sideways consolidation. A point, a point, a point, a point. And prior to the sideways consolidation, in both cases, there was a strong rally. So our fractal really is a strong rally, the market needs to consolidate its gains. A strong rally, the market needs to consolidate its gains. The similar consolidation periods, in this case it was 7.84 years. This is a much longer consolidation period. This point, this point, this point, all the way out to this point. It's 19.27 years. And we already know what happened on the left side. After the bullish breakout, the market rallied for 1,026 days. The move from point A to point B was 68%. Therefore, if the concept, the longer a market goes sideways, the bigger the move you can expect to get. This is a much longer period of consolidation with a very, very similar market fractal. If we put a pen to paper, this is 2.45 times longer than this consolidation period here, telling us if we had a 68% gain after a roughly 8-year consolidation, it's possible that we could get a 68% gain or quite a bit better after a 19-year consolidation period with a similar pattern or fractal. The moral of the story for us is simply, as long as this bullish breakout holds, and that's to be determined, we take it day by day, this helps us remain open to much better than expected long-term outcomes. You'll notice these fractals have very similar proportions, a rally, sideways, a rally, sideways. If those proportions remained in place, we would expect the gain over here to be larger than this gain, and we would expect the duration in this direction to be longer, just as the duration was longer here. The longer you go sideways, the bigger the move you can expect to get. It applies to percentage gains and duration. If we do some very, very simple math and use our ratio here, multiply 2.45 by 68%, that would estimate a 166% gain. And if the time were 2.45 times longer, just as the consolidation period was, we would rally for 2,500 days, which is almost 7 years. As we've stated many times, we are not forecasting here. We are basically looking at facts that we have in hand and drawing some reasonable conclusions. If the facts change, then we have to remain flexible enough to adjust. Another way that this can help us, if the fractal or just the concept of consolidation in a bullish breakout holds, and we do get a move in this direction that exceeds expectations on the upside, similar to this move here that exceeded expectations on the upside, we know within the context of any bullish trend between a point A, a multiple year point A and point B, there is going to be gut-wrenching volatility along the way between point A and point B. 100% normal and to be expected counter-trend moves within the context of an ongoing bullish trend. So studying the historical case also reminds us that we have to discern between normal volatility to ignore within the context of an ongoing uptrend, and what eventually will morph into volatility to respect, where we have to take incremental defensive action. How long the present day trends last is anyone's guess, and from our perspective, it doesn't matter. We take it day by day and look at the data. We look at the data and say, are we allocated prudently based on the facts that we have in hand? If the answer is yes or I'm not sure, leave it alone. Always default when you're not sure to the primary trend and the facts in hand. We also have to be flexible enough to make changes when inevitable. Difficult times rear their ugly head. It's going to happen. It's part of any long-term bullish trend, and it's part of any transition from a bull market to a bear market, which will absolutely positively happen at some point in the future that is to be determined. Given all things being equal in the stock market, simple is better than complex. Let's look at the same situation from a different perspective and simpler perspective. Now we're looking at a large version of the same chart, value line geometric index. This is calendar year 1980 on the left, and this is the present day as of July 26, 2017 on the upper right. To simplify things, our fractals are basically the market rallies and then the market needs to consolidate its gains. The longer fractal, the market rallies, the market needs to consolidate its gains. It's as simple as that. It's the way markets work. Massive moves are typically followed by periods of consolidation. Big moves are typically followed by periods of consolidation. And using that simple approach, and here we're starting to see how the two fractals and how the market moves in similar ways on different time frames. This is a shorter time frame with similar movement. This is a longer time frame with similar movement. This green portion here is just the 1980 to 1995 fractal that we've been looking at, and the purple portion is the larger 1980 to 2017 fractal. This fractal is inside of the larger fractal. For a little clearer visual to tie this big chart into the smaller charts, here's our smaller fractal side by side with the larger fractal. When we started, we had the time frames in years removed, and we've shown that price movement on both time frames has been very similar. Now let's take the simple concept one step further. You'll notice a lot of the expressions in the market needs to consolidate its gains. The longer you go sideways, the bigger the move you can expect to get. A move followed by a sideways range often precedes another move of almost equal extent in the same direction as the original move. How does that apply to our charts in the present day? Let's walk through it. A move. Here's a move, followed by a sideways range, followed by a sideways range. The market needs to consolidate its gains. The longer you go sideways. Often precedes this move, and this often precedes another move of almost equal extent in the same direction. This is another move of almost equal extent in the same direction. The basic concept is markets tend to rally, maybe overshoot, consolidate, break out, and rally again. This quote and these moves here are tied to our smaller market fractal. The same concepts apply to our larger market fractal. A move followed by a sideways range often precedes another move of almost equal extent in the same direction as the original move. If, and I emphasize if, hypothetically, this quote and these concepts apply, and it's within the realm of possibility that we could see over a very long period of time and with lots of volatility between point A and point B, another move of almost equal extent in the same direction as the original move, which would mean moving this line over here. This move, this box, and this move and this quote apply to our larger market fractal. The greatest understatement of all time would be to say that the future is very uncertain in the financial markets. Therefore, this can help us from a bullish perspective. It can also potentially alert us to problems from a bearish perspective. How? We can monitor this breakout here. This is the breakout on a weekly chart, and this is the breakout that we covered on See It Market. This is the daily chart. As long as this breakout holds, then the bias would be to lean towards the bullish case. If the breakout fails, which is absolutely positively within the realm of reason, that tells us to be open to worse than expected outcomes, at least in the short to intermediate term. So this analysis can help us keep an open mind about better than expected outcomes and possibly worse than expected outcomes. The concept of a long-term consolidation and breakout is covered in detail in this See It Market article dated July 26, 2017. You should be able to find it by Googling this title here or going to See It Market. It appears on the homepage as of Thursday, July 27th. This post has numerous charts that let you zoom in and see the actual detail of the sideways movement at the top of the range, as well as the sideways horizontal go nowhere movement at the bottom of the range, which speaks to indecision and consolidation. And we all know that once you break from a long-term consolidation, typically you get a big move. Market fractals tell us that concept applies to a 1-minute chart, a 10-minute chart, a 30-minute chart, a daily chart, a weekly chart, a monthly chart, and even a 35 or 40-year chart. On a daily chart, the number to watch is roughly 508 for the value line geometric index. As of the close on July 26th, we were trading above 508 at 531. We try hard to make these videos as accurate as possible. We want to make a little bit of a correction from last week's video. We covered these bullet points here, and we specifically want to zoom in on this bullet point. Given the state of the charts and the hard data that we had in hand in this period, it's not really accurate to say the model helped us stay bullish pre and post Brexit and pre and post US election. This statement here is much more in line with the state of the charts in calendar year 2016. The model and hard data helped us remain open to bullish outcomes in a very difficult period after Brexit, before the US election, and immediately following the US election. We know from our long-term signal that we covered on August 19th that the long-term charts started to turn after the Brexit referendum and before the US election. Our intention with this bullet point was to highlight the difficulty of this period. Futures went limit down the evening after the Brexit referendum, and the US futures went to max fear or limit down after the returns and votes were counted in the United States. So Brexit referendum occurred on June 23rd. After that, the chart started to turn as we reported in August. And of course, the US presidential election was on November 8th. Which ties in nicely with this week's video, because we know that harder markets, volatile and difficult markets, are often followed by easier markets. Harder markets. This is an incredibly difficult, volatile, and wild period in here over the last 20 years. Harder markets are often followed by easier markets, marked by stronger long-term trends. And we can't emphasize enough, even if the chart patterns lead to way better than expected outcomes over the next 5 to 15 years, volatility will 100% be part of the package. Markets are never going to make it easy for anyone, and the more closely we monitor the market and our account balances, the more difficult it's going to be to navigate from a point A to a point B. Our focus and allocations are slanted towards the long-term outlook. Why? The hard data that we have in hand currently says that is prudent. Our focus will become more short-term when the data starts to roll over and we get flatter slopes and a more indecisive look. We do need to monitor things more closely with a profile like this, When we have a profile like this, if we're watching the market tick by tick and watching our profit and loss second by second, it is absolutely, positively going to hurt us rather than help us. Therefore, it would be helpful in the present day. Do the charts look more like this? Let's keep our focus on the long-term horizon, or are they starting to roll over in a concerning manner? And since we know from past videos that present-day trends, 2017 trends, have been strong, it might be helpful to compare the present day to a strong trend in a period where we had a sharp correction. So we had this waterfall decline here in 2011. These are the same moving averages that we used for illustrative purposes, only in generic moving averages, the same ones we used in last week's video. This is a rollover to a correction. This is what a strong trend looks like. Let's look at the rollover first. Are there any warning signs that something like this might happen? Number one, look at price. It's been moving sideways here for literally 7 full months. Really no progress at all. And that waning momentum starts to get reflected in the moving averages. You can see blue is starting to roll over and price is touching it here on June 1st. This waterfall decline doesn't happen for almost 2 months after this point. So we have price waving yellow flags. We have price hitting the moving averages 1 time, 2 times, 3 times, 4 times before really bad things happen. And also notice, unlike the strong trend where price goes down and typically bounces at the moving averages, in this case we went all the way below the moving averages. We don't have anything like that during this strong period where the market was trending strongly in calendar year 2013. We can also see the moving averages make a discernible lower high along with price. So both price and the moving averages are waving some yellow flags here. We really don't have anything like that in here. No lower highs from the moving averages and no serious and discernible lower highs. This is a lower high and this is a lower high, and this is our waterfall decline. And as price starts to cut through the moving averages here, they start to roll over in a bearish manner. We never really have any rollover look in here. We have a little bit of a waning trend, but this is a strong look. Also, we can look at the slopes of the moving averages. A few months, going backwards, a few months from this point here, if we draw a line on the blue moving average from point to point, this is the slope of the line and shows us a very, very strong and what looks like a sustainable trend. This type of slope usually has volatility to ignore, followed by a higher high. Volatility to ignore, followed by a higher high. Volatility to ignore, followed by a higher high. And that's the key. If you withstand the volatility, you get rewarded with a higher high and even higher profits than you had prior to the pullback. Let's contrast this upward sloping, strong slope with this slope. I can see this slope. I can draw this slope before this waterfall decline. This is a waning trend with price near a tight cluster of moving averages. This is a big yellow to red flag in here. We can draw this line here before the waterfall plunge. Blue is here, blue is here. I draw the line point to point and I look at the slope. Therefore, how does the present day, and in the case of this recording, this is being recorded late on Thursday evening, July 27th. How does the present day compare to a waning trend, a rollover look to a major bear market, and a strong trend? These are the exact same moving averages as of the close on July 27th, and we can unequivocally state that the present day looks a lot more like this strong trend in 2013, which is exactly what we would expect based on the research and the things that we've covered in videos looking back 10 months. It really doesn't look anything like this high-risk period here. Also noteworthy, when you have strong trends, the math is typically not impacted by pullbacks. Look at the moving averages. They don't change at all here. The trends remain intact. volatility to ignore. You get a big drawdown here, volatility to ignore, a normal pullback, volatility to ignore, and a pullback. If we draw the same line point to point on the blue moving average from here to here, we can see the trend in the present day looks a lot like the trend at this point in 2013. This is December 31st, 2013, and really doesn't look anything like the waning trend that we could see in the evidence that we had in hand before this big plunge in calendar year 2011. And here's another example, even within the context of an extremely strong bullish trend, we know we are going to get a ton of volatility. Look how difficult it is to navigate from point A to point B if we are watching the market too closely, if we're watching our account balances too closely, and if we're watching our profit and loss too closely. The present day trends tell us the next pullback that we get, even if it's fairly significant, which it could be, this is a multiple week gut-wrenching pullback in here. It's telling us the next pullback will most likely be followed by a higher high. That speaks to probabilities. That's not the case in here. We're not nearly as confident about making a higher high in short order with a look like this. It's also extremely important to note, this is Thursday evening, if Friday is weak, it is extremely and highly unlikely that the math would change in a material way in one trading day. And since a picture is worth 1,000 words, we recorded this segment Friday morning, July 28th at 10:48 a.m. And to help prove the point, the S&P 500 on Friday intraday was down roughly 9 points, 8.8 points. And as we can see, the math and the trends and the look of the moving averages has not been impacted in a material manner. We'll take it day by day, and we're open to all outcomes. What happened next after this period here? The present day looks similar. What happened from this point here on December 31st, 2013, if we were able to stay invested between a new point A and point B? The answer is we continued to make a series of higher highs and higher lows, and this market rallied from December 31st, 2013, an additional 15.26%. We went from 1848 on the S&P 500 to 2130 on May 22nd, 2015, which segues nicely into these important bullet points. Volatility is absolutely, positively not the enemy. Volatility is only the enemy if we believe it's the enemy. Volatility, as we've shown in numerous videos, is a normal part of all trends. Unfortunately, markets always have been and always will be volatile. Since we cannot change the markets, we must accept the markets as they are. Volatility is only the enemy if we perceive it to be the enemy. If we want to navigate between a point A and point B and prudently manage risk along the way, really the only thing we should be watching is whether or not we believe it's volatility to ignore or volatility to respect. The markets are not going to change, but we can change our perception of volatility. If we understand volatility better than the average investor, volatility can be our friend, can help us successfully navigate between a point A and point B. It can also help us manage risk when we see signs that we're morphing into volatility to respect. Thankfully, the present day base case looks a lot more like this period here than this period here. track all of this and convert it into a usable and actionable format in a reasonable amount of time. The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.